Hello, welcome back to Economic Insights. We are back after a long break. I'm Alex, and joining me as always is Selim, our market veteran and show producer. Selim, what a week we've had. Government shutdown drama, trade tensions flaring up, and that shocking sell-off in gold. Where do we even start?
Well, we're definitely not starting in a boring place. It was a week of real whiplash. Optimism early on, then panic midweek, and then cautious relief by Friday. The markets are basically doing their best impression of a mood ring right now.
Let's back up. The big story everyone was watching was US inflation data. The CPI came in softer than expected. What does that tell us?
So, headline inflation came in at 0.31% month over month and core at 0.23%, both softer than expected. The real surprise was shelter prices, particularly something called owner's equivalent rent. It hit its lowest monthly reading since early 2021. Now, here's the thing, most analysts think this is noise rather than signal. Shelter usually bounces back quickly, so don't expect this to repeat.
Got it. So it's a one-off, not a trend?
Right. That said, core goods prices, excluding vehicles, are showing actual increases tied to tariff pass through. You're seeing the trade war show up in prices now. But overall, the data supported what everyone was already expecting.
Which was what?
A 25 basis point rate cut from the Fed coming this week. Insurance cut, they're calling it.
Now let's talk about the geopolitical mess. US-China trade relations seem like they might implode midweek, right?
The week started strong. Trump's deadline to impose 100% tariffs on China was November 1st, and the market smelled a deal. Then reports surfaced that the administration was considering restricting software exports to China. The Philly Semiconductor Index tanked 2.36% in response.
That's nasty.
Very nasty. But then Trump confirmed he'd meet Xi at the APEC summit on October 30th, and suddenly the market took a deep breath again. Classic Trump. Keep eating your tacos.
Ha ha ha. My favorite. I also like the food. What about Russia? I remember reading that oil prices spiked.
Exactly. The US Treasury sanctioned Russia's two largest oil producers, Rosneft and Lukoil, citing lack of commitment to a Ukraine peace process. This caught markets off guard because just weeks earlier, people were talking about Trump and Putin potentially meeting. So Brent crude jumped 5.4% over 2 days, the biggest move since April 2022. Nearly 70% of Russia's oil production is now under some form of restriction.
So oil got a real boost from that?
Absolutely. Started the week at a 5 month low of $61 a barrel, then surged on news that the strategic oil reserve would be refilled, and then the sanctions pushed it even higher.
Rough week for Trump's trade negotiations on other fronts too, wasn't there?
He terminated negotiations with Canada over an Ontario advertisement criticizing tariffs and slapped on an extra 10% on Canadian goods. The irony being that all of this is meant to be pro growth, and instead you've got businesses facing uncertainty on multiple fronts.
And that government shutdown? How long have we been in this now?
Too long. I stopped counting. The market went from thinking it would wrap up quickly to assigning a 75% probability it becomes the longest shutdown in US history. That's creating real economic drag. Estimates suggest about 0.1% quarterly annualized GDP loss per week.
Ouch. How's that playing into the Fed decision this week?
It's part of the insurance logic. Weak labor market data, the shutdown's growth impact, political tension with the White House. The Fed's doing a rate cut partly to manage all that risk, not just inflation.
Let's dig into the developed markets. US bonds had quite the week.
US Treasuries got interesting. The 10-year started the week below 4%, actually hit 3.96% early on. Long-term yields, 30-year, fell to their lowest since April. Growth fears plus a weak Philly Fed manufacturing index really compressed yields downward.
Then what?
Then oil prices surged on the Russian sanctions, and suddenly you got this bond sell-off on October 24th. The 10-year yield posted its largest daily rise in over a month, about 5 basis points, back to 4.00%. It's a tell, that oil markets and inflation expectations are recoupling in investors' minds.
So, from a policy perspective, the Fed's expected to cut 25 basis points and signal the end of quantitative tightening earlier than planned, right?
Yeah, the Fed's been running down its balance sheet as part of QT. They were supposed to keep that going longer, but there were signs of strain in funding markets, overnight repo rates ticking up, so they're expected to announce it wraps in December or January, sooner than projected. Impact on yields is modest, maybe 3 basis points lower on the 10-year, slightly flatter curve. Not a game changer, but important for managing transition in funding markets.
Moving to Europe, the ECB's meeting this week, but sounds like it's a non event.
Completely. They're expected to hold rates steady. The narrative is we're in a good place, data dependent, meeting by meeting approach. Flash PMI data actually improved, helped by services. But manufacturing remains weak, consumption is soft, and external risks are real. So the base case is that a lackluster European growth continues. No reason for the ECB to cut or hike right now.
What about the euro itself?
Eurodollar has been trending bearish below the 50-day moving average. Expectations are for it to slide toward 1.13 or even 1.12. The PMI data gave it a small boost, but there's still downside bias.
And in the UK,
UK CPI for September was a downside surprise. Headline stayed at 3.8% versus 4.0% expected. Core fell unexpectedly. That sent gilts higher and had investors betting on another Bank of England rate cut this year,
now to Japan. New Prime Minister just took office.
right? And that's where things get interesting. The BOJ is expected to hold this week, but there's some debate over whether they might actually hike. The terminal rate is priced to reach 1.25% by March 2028, which is all about US economic direction anyway, so not likely to shift much at this meeting.
What's the fiscal story there?
Concerns about aggressive fiscal expansion under Takaichi have actually eased. The government looks like they'll avoid ramping up special deficit financing bonds. That's calming some of the instability in Japanese government bonds, though the long end remains fragile. Structural weakness, potential defense spending reaching 2% of GDP, those are real headwinds. But pension funds have been the biggest buyers of super long Japanese government bonds recently, and they're expected to keep rebalancing into bonds because equities have been so strong. That's propping things up for now.
Japan's had quite the equity run. Nikkei hit record highs earlier this week.
Yeah, Japanese and Korean markets both hit records, though they sold off when the trade war fears escalated. Classic risk-off move.
Let's talk FX. The yen's been front and center.
The yen is basically the epicenter of G10 FX trading right now. Markets priced out an October rate hike by the BOJ, so the yen underperformed. Dollar yen and carry trades are going to be heavily dependent on what the BOJ does this week. Along with the Fed, the BOJ meeting is one to watch out for this week.
Global growth seems to be supporting a weaker dollar view, though.
In principle, yeah. Soft US inflation and growth signals are mixed, but are not alarming globally. The problem is the government shutdown has actually worked in the dollar's favor because limited data releases mean markets focus on problems elsewhere. Europe's sluggish, China's got its own issues, so the dollar's shown resilience despite the macro case for it to weaken.
Now, the commodity story, gold was absolutely wild. A 30% rally that just collapsed?
Absolutely wild. Gold hit a record after this extraordinary 2-month 30% rally. Then, on October 22nd, it posted its biggest decline since August 2020, down over 5%. And this is despite falling bond yields that should support gold. That's the kind of move that makes you think it's a healthy correction within a longer bull trend, not a reversal.
What triggered the sell-off?
Hard to say with absolute certainty, but some combination of technical selling, taking profits on the massive run, and the geopolitical shock of the Russian sanctions reversing the flight to safety bid. Once the gold started selling and sentiment shifted, it cascaded.
And oil we touched on. The Russian sanctions pushed it higher?
Brent went substantially higher after the sanctions. The sanctions hit nearly 70% of Russia's crude production and export capacity. That's a significant supply constraint, at least on the margins.
Let's hit the emerging market story. Turkey's had some drama with CBRT rate cuts.
Not the kind you watch on TV, and not even a drama by Turkish standards. The Central Bank of Turkey cut rates by 100 basis points to 39.5%, but in a more hawkish tone than before. The accompanying statement acknowledged that disinflation is slowing, underlying inflation is ticking up, and they're worried that high inflation is anchoring expectations. So this was clearly a pause in the easing cycle. The court case against the opposition CHP was thrown out, which removed some anxiety there, and the lira appreciated modestly. But the outlook for further cuts is murky because of the inflation stickiness and potential upside risks from the Russian energy sanctions.
What about Egypt? That's showing genuine recovery?
Egypt's economic growth hit 4.4% in the fiscal year 2024 to 2025, driven by tourism and non-oil manufacturing. Headline inflation is expected to ease to around 14 to 15% this year, thanks to a stable currency and falling food prices. The Central Bank of Egypt has already delivered 625 basis points of cuts this year and is expected to do maybe 725 basis points total for 2025. There's actually a case for going even deeper. Egypt remains one of our favorites within EM space.
South Africa?
Inflation rose just modestly to 3.4% year over year from 3.3%, another downside surprise. So the South African Reserve Bank, the SARB, is on hold. We remain bullish on duration in South African local bonds, though the South African rand took some volatility hits this week, courtesy of that gold price collapse. Gold's a key driver for the rand.
And lastly, Hungary?
The National Bank of Hungary held the policy rate at 6.50% and maintained a hawkish stance. Hungarian government bonds remain the favorites in the Central Eastern Europe region. Strong overweight on duration, especially if you're unhedged on FX.
So, next week, this is the big week for central banks, right?
Absolutely. The Fed and Bank of Canada go on Wednesday, ECB, and Bank of Japan on Thursday. The Fed's the most important meeting to watch.
What's the market pricing for the Fed?
Universal expectation of a second consecutive 25 basis point cut. There's also the anticipated announcement ending quantitative tightening. The balance sheet runoff should conclude in December or January. Post QT, the Fed's expected to just maintain the balance sheet size without further shrinkage. This whole policy path is about ensuring against employment and political risks, which means the Fed's signaling willingness to tolerate inflation somewhat elevated above the 2% target.
Any wildcards?
Well, Trump's heading to Asia and meeting Xi on the sidelines of APEC. That's a big geopolitical moment for markets. In Europe, the newly formed French government is already looking shaky and under pressure for more budgetary concessions. And in the US, you've got massive Q3 earnings from the tech giants Microsoft, Alphabet, Meta, Apple, Amazon, which could cause headlines even as we're starved for economic data from the shutdown.
So, tech earnings, central bank decisions, Trump C meeting, and potentially the longest U.S. government shutdown on record. Busiest week in a while?
Busiest week in a while, and probably a lot of volatility ahead. Markets don't like uncertainty, and we've got uncertainty on trade, fiscal policy, central bank balance sheets, and geopolitics all converging.
Before we wrap up, important reminder. Don't forget, folks, we do not give investment advice. For that, please consult a professional. So, same time next week?
Wouldn't miss it. Should be quite the week ahead.
Thanks for joining us on Economic Insights. Take care, everyone.